Fear and anticipation are at an all-time high as tensions escalate between China and Taiwan. Right now, as we stand just steps from the U.S. Department of Defense in Washington, D.C., global markets are bracing for what some analysts call a potential seismic shift. Imagine this, a 55% chance of a military confrontation within the next 2 months, threatening the heart of Taiwan's semiconductor industry, which powers everything from your smartphone to critical defense systems worldwide.
Taiwan isn't just another island. It's the silicon lifeline of the global economy. Companies like TSMC supply over 60% of the world's semiconductors, and if Taiwan's production is disrupted, the economic shockwaves will ripple far and wide. The semiconductor shortage of the past few years would pale in comparison to what could happen. This isn't saber-rattling as usual. There's a deep strategic urgency behind China's moves. For investors, the stakes have never been higher. Do you hold steady riding the highs and lows of uncertainty? Or do you start seeking safer ground now before the storm hits?
This situation is about more than just semiconductors. The economic implications span industries and continents. A single blockade in the Taiwan Strait, and we're looking at potential shortages in everything from advanced chips to energy resources, as oil shipping routes through the South China Sea are blocked or delayed. This could mean skyrocketing oil prices, further straining economies already grappling with inflation. And it's not only investors feeling the heat, policymakers and tech giants are scrambling to consider what this means for global stability.
Exactly. Today we'll explore what a conflict in the Taiwan Strait might mean for the industries you invest in most: semiconductors, energy, defense, and more. We'll look at what steps governments and major players are taking to prepare, from ramping up domestic chip production to increasing military presence in the region. And most importantly, we'll highlight actionable strategies that could shield your portfolio or help you find opportunity even amid this potential crisis.
This episode is about more than numbers and trends. It's about understanding how global tensions shape your financial future. The risks extend beyond Asia, and an escalation here could impact everything from the price of fuel to the availability of key tech components. We're talking about ripple effects that could hit markets around the world, from Wall Street to Tokyo. Join us as we go beyond the headlines to uncover strategic plays and portfolio shifts that could be critical in the weeks to come.
So whether you're motivated by caution or the chance to capitalize on a shifting landscape, this episode has insights for you. When the odds of conflict are over 50%, ignoring the potential impacts on your financial future could be costly. Let's get into the dynamics, the risks, and the opportunities that lie ahead. Today, we're here to help you navigate a world where geopolitical tensions aren't just stories. They're shaping your financial reality.
Stay with us as we dive into the latest developments and share insights on how to adapt your strategies in light of this evolving situation. And don't forget to subscribe to Finance Frontier for real-time updates on financial trends that could reshape markets and your portfolio. Let's dive into today's top story, a situation that's left markets and policymakers on edge. With a 55% likelihood of a China-Taiwan conflict within the next 2 months, this isn't just a typical diplomatic dispute. Over the past few weeks, China has significantly increased its military activity around Taiwan. In what's known as Joint Sword 2024B, we're seeing simulated blockades and naval exercises on a scale we haven't seen before, with over 125 warplanes and a substantial naval fleet positioned near Taiwan. It's a move that has left analysts questioning just how close we might be to a critical escalation.
The implications are huge. Taiwan's strategic importance goes beyond geography. It's the heart of the semiconductor industry. Companies like TSMC produce over 60% of the world's advanced chips, fueling industries from automotive to artificial intelligence. If tensions escalate to the point of conflict, we could see an unprecedented disruption in this supply chain. Imagine the semiconductor shortage we've experienced recently, but magnified across every industry that relies on these chips. Investors with exposure to tech and manufacturing are understandably cautious, as the potential for volatility grows with each passing day.
And the stakes aren't limited to semiconductors. The Taiwan Strait isn't just a narrow stretch of water, it's a vital shipping lane. Around 30% of global maritime trade passes through the South China Sea, including critical oil routes to Japan, South Korea, and beyond. Any disruption here could lead to an immediate spike in oil prices. Recent estimates suggest that a conflict could increase global oil prices by 15 to 20%, compounding the inflationary pressures that economies worldwide are already struggling with. An oil surge could ripple into daily life, with higher prices impacting everything from transportation to household goods.
This situation has caught the attention of the U.S. government and its allies. Capitol Hill discussions are underway to fast-track domestic semiconductor production, but building the infrastructure to replace Taiwan's output would take years, not months. Even with a massive investment push, experts estimate it could take at least 5 years for the U.S. to catch up to Taiwan's level of sophistication in semiconductor manufacturing. If the crisis deepens, there's simply no way for the U.S. or its allies to replace Taiwan's chip production in the short term. This dependency means a disruption in Taiwan could cause a tech ripple that affects everything from smartphone production to defense systems.
For investors, the risks are serious. Tech stocks, especially those heavily reliant on Taiwanese semiconductor suppliers, could see significant volatility if conflict disrupts production. Nvidia, AMD, and other companies could face immediate supply issues, leading to potential price swings that ripple across the entire tech sector. Diversifying portfolios now could be a critical step, especially by exploring assets that offer resilience against such sector-specific disruptions. In these conditions, protecting gains in tech might mean looking beyond tech altogether, at assets that can offset losses during turbulence.
It's not just about defensive plays either. Commodities like oil and safe haven assets like gold stand to benefit as investors flock to stability. Energy companies with exposure to Asia-Pacific markets could see increased demand if oil prices rise. Meanwhile, precious metals like gold, often viewed as a store of value during crises, are gaining attention as a potential hedge against both inflation and currency instability. This kind of strategic positioning might shield portfolios from tech-related volatility, while providing potential upside. With inflation rising and interest rates uncertain, these commodities offer a practical form of insurance.
And while investors and policymakers look to shield assets, China is well aware of Taiwan's strategic importance. This isn't just about military presence, it's about the broader power dynamics in global trade and tech dominance. We're looking at potential shifts in energy, tech, and defense sectors that could impact not just Asian markets, but also Western economies. The results could mean long-term changes in how and where companies source components or even where they set up production. These are developments that demand careful portfolio positioning and awareness of new risks and new opportunities.
As always, geopolitical tensions bring both risks and opportunities. This is a time to be cautious, but also to stay alert to sectors that may experience growth in a high-risk environment. Today's moves could shape the landscape for years to come, from increased investment in defense and energy to renewed interest in domestic tech manufacturing. And on that note, let's turn to social media, where analysts, investors, and commentators are already making their opinions heard. Their insights add real-time perspectives on this evolving story and what it could mean for markets.
Shifting over to social media, the China-Taiwan situation has lit up conversations, with investors, analysts, and even former policymakers weighing in on what could happen next. One tweet catching a lot of attention from a well-known financial analyst says, a 55% chance of escalation isn't just a statistic. It's a warning signal for portfolios tied heavily to Taiwan's semiconductor output. This observation is hitting home with tech investors who are now closely examining their reliance on stocks like Nvidia and AMD, which are directly linked to Taiwanese supply chains.
Another trending thread dives into the broader impacts a conflict could have beyond the tech sector. One comment in this thread says, think back to the pandemic chip shortage but multiply that by 10. This isn't just about tech. This affects every sector that depends on semiconductors. That perspective is resonating widely as investors start seeing the interconnected nature of this risk. It's prompting some to assess exposure not just in tech but across sectors like automotive, consumer electronics, and healthcare, where chip supply is crucial.
Energy security is also taking a front seat in these discussions. A widely shared post warns, if the South China Sea shipping lanes are compromised, expect oil prices to skyrocket. Commodities are now essential. This sentiment captures the growing awareness of how a conflict could disrupt critical energy supplies. Discussions are increasingly focused on energy ETFs and direct commodity holdings as potential hedges. It's clear that strategic investments in oil and energy assets are top of mind for those looking to shield their portfolios from potential supply chain shocks.
Another powerful point circulating on social media centers on sanctions as a strategic tool. In a popular thread, a former defense official suggests, we may see economic warfare before military moves. Sanctions could hit tech and energy sectors as hard as a physical blockade. This viewpoint is gaining traction, with commenters debating whether economic restrictions could have an equally disruptive impact on global trade and tech. Investors in these threads are asking, how can we build resilience into our portfolios? It's a theme that's resonating across multiple platforms as people look for ways to protect assets from both physical and economic threats.
And let's talk about commodities. There's a growing consensus on social media that traditional safe haven assets like gold are coming back into focus. Tweets refer to gold as an anchor in the storm, with one user commenting, "Gold's role isn't just about inflation right now, it's protection against broader geopolitical chaos." This sentiment captures the renewed interest in gold, not just for inflation hedging but for stability amid volatile markets. As investors weigh the risks of a China-Taiwan conflict, many see precious metals as a valuable addition for added security.
For our listeners, these insights from social media are a real-time window into market sentiment as it shifts with each new development. Social platforms are reflecting a mix of caution and proactive strategizing, with investors discussing everything from commodities to defensive tech positions. Staying engaged with these conversations is a way to keep strategies adaptable and informed. And as always, we welcome you to join the discussion and share your own perspectives as this story unfolds. Staying connected could be key to navigating what lies ahead.
Now that we've covered the headlines and social sentiment, let's dive into strategies for navigating this high-risk environment. With a 55% chance of a China-Taiwan conflict within the next 2 months, the stakes are high for investors who hold assets tied to Taiwan's semiconductor production or energy supplies dependent on Asian trade routes.
Let's start with a fundamental approach to de-risking tech exposure. Many tech stocks, especially those reliant on Taiwanese semiconductors like Nvidia and AMD, could see sharp volatility if tensions escalate. For investors, this means considering a rebalancing of portfolios toward US-based semiconductor companies or tech ETFs with lower direct exposure to East Asia. Some investors are even exploring inverse ETFs, such as SQQQ, as a short-term hedge against potential declines in tech-heavy indices.
And there's growing focus on commodities. With the potential for supply chain disruptions in the South China Sea, energy and precious metals are emerging as go-to hedges. Oil, in particular, could see substantial price hikes if shipping lanes are disrupted, which is why investors are looking at energy ETFs and direct oil investments as part of their strategy. We've seen social media posts pointing to oil as a must-have, with one user noting that commodities are essential in any portfolio facing high geopolitical risk.
Precious metals, especially gold, are gaining traction for those looking for a stable hedge. In recent weeks, there's been a renewed focus on gold as not just an inflation hedge, but as a safeguard against broader market instability. One popular tweet captures this sentiment well, calling gold an anchor in stormy waters. Investors are adding gold ETFs or even physical metals to their portfolios to provide a buffer in case the tech and energy markets face heightened volatility.
Another approach involves defensive positioning in the defense and aerospace sectors. Companies with defense contracts or exposure to military technology may experience increased demand if geopolitical tensions rise. For instance, adding aerospace or defense stocks provides some upside potential in a scenario where military spending might increase. Social media threads suggest this sector as a growth opportunity amid instability, underscoring its appeal as both a defensive and growth-oriented play.
For those with higher risk tolerance, option strategies are another way to manage potential downturns. By using call options on inverse ETFs like SQQQ, investors can hedge against declines in tech stocks. Meanwhile, stop-loss orders on tech-heavy assets offer a safeguard if markets experience rapid downturns. As one user noted, a stop-loss plan can act as your guardrail when the unexpected hits. By setting automated thresholds, investors can minimize losses even when market conditions shift suddenly.
And for those wanting to stay within the tech sector but reduce risk, consider diversifying into safer tech-adjacent areas. Data center REITs, for example, provide tech exposure without being as vulnerable to semiconductor supply disruptions. Cloud-based software firms may also offer lower volatility compared to hardware-focused companies, as they are less reliant on physical supply chains tied to Taiwan. This form of diversification lets you retain tech exposure but with less direct risk linked to geopolitical uncertainties.
The key takeaway here is that strategic portfolio adjustments can provide both protection and potential gains. Diversifying across commodities, precious metals, defense stocks, and safer tech sectors offers a layered approach to managing risk while maintaining growth potential. With the market as uncertain as it is, adopting these proactive strategies might be essential for navigating the coming months.
Now that we've covered the headlines and social sentiment, let's dive into strategies for navigating this high-risk environment. With a 55% chance of a China-Taiwan conflict within the next 2 months, the stakes are high for investors holding assets tied to Taiwan's semiconductor production or energy supplies dependent on Asian trade routes.
Let's start with a fundamental approach to de-risking tech exposure. Many tech stocks, especially those reliant on Taiwanese semiconductors like Nvidia and AMD, could see sharp volatility if tensions escalate. For investors, this means considering a rebalancing of portfolios toward US-based semiconductor companies or tech ETFs with lower direct exposure to East Asia. For additional protection, some are even exploring inverse ETFs, such as SQQQ, as a short-term hedge against potential declines in tech-heavy indices.
Commodities are also emerging as essential components of a risk-managed portfolio. With the potential for supply chain disruptions in the South China Sea, energy and precious metals are gaining attention as hedges. Oil, in particular, could see substantial price hikes if shipping lanes are compromised. Energy ETFs and direct oil investments offer a way to offset potential declines elsewhere. Social media posts are echoing this sentiment, with one investor noting that commodities are essential in any portfolio facing high geopolitical risk. This is an environment where energy security has direct portfolio implications.
Gold and other precious metals are also coming into focus. Recently, there's been renewed interest in gold, not just as an inflation hedge but as a hedge against geopolitical instability. A popular tweet captures the current sentiment, calling gold an anchor in stormy waters. Adding gold ETFs or even physical metals to a portfolio provides a way to buffer against potential volatility in the tech and energy sectors. Analysts from major financial news outlets are noting similar trends, with projections that gold could outperform other assets if tensions continue to rise.
Another approach involves allocating to the defense and aerospace sectors. Companies with defense contracts or exposure to military technology may experience increased demand if geopolitical tensions escalate. Adding aerospace or defense stocks can offer upside potential in a scenario where military spending is ramped up. Social media threads suggest this sector as a growth opportunity amid instability. For investors, it's a way to hedge against potential losses in tech while tapping into growth in sectors likely to receive increased funding.
For investors with higher risk tolerance, option strategies are also being considered to manage potential downturns. Call options on inverse ETFs such as SQQQ provide a hedge against declines in tech stocks, while stop-loss orders on tech-heavy assets offer a safeguard if markets turn volatile. As one user put it on social media, a stop-loss plan acts as your guardrail when the unexpected hits. By setting automated thresholds, investors can react instantly to sudden market shifts.
Another layer to consider is diversification within tech itself. Some investors are moving toward tech-adjacent areas with less exposure to semiconductor disruptions. Data center REITs, for example, offer tech exposure without direct vulnerability to Taiwan's production. Cloud-based software firms may also provide lower volatility than hardware-focused companies reliant on physical supply chains. This allows investors to stay in tech without being as exposed to Taiwan-related risks, adding stability to growth portfolios.
It's worth noting that recent news reports underscore the importance of diversifying geographically too. There's been a growing interest in Latin American tech and industrial stocks, as investors seek alternatives outside of Asia. With supply chains under threat, some are looking at emerging markets that offer relative stability. This broader diversification can help offset risks tied specifically to Taiwan while tapping into other growth markets.
The takeaway here is that a layered, diversified approach can offer both protection and growth potential. Rebalancing across commodities, precious metals, defense stocks, and safer tech sectors equips investors to handle a volatile market environment. With such high geopolitical risk, adopting proactive strategies might be critical in the coming months. Whether it's through commodities, alternative tech, or defense sectors, these moves could make all the difference for a resilient portfolio. Now it's time for our listener Q&A segment, where we address your questions on managing market risks tied to the China-Taiwan situation. Our first question comes from Jessica in Seattle, who asks, with the high likelihood of conflict, should I reduce my exposure to tech stocks entirely?
Great question, Jessica, and it's one that's come up a lot lately. Rather than pulling back from tech entirely, consider rebalancing. Instead of overloading on stocks heavily reliant on Taiwanese semiconductors, like Nvidia and AMD, some investors are looking at US-based semiconductor companies or tech ETFs with reduced exposure to East Asia. This way, you maintain tech growth potential but reduce the specific risks tied to Taiwan's supply chains.
Our next question is from David in Boston, who asks, would it be wise to move into commodities like oil and gold given the geopolitical risks? Absolutely, David. Commodities can act as a strong hedge in volatile times, especially with the risk of South China Sea supply disruptions. Oil ETFs and gold assets add resilience to portfolios, as these commodities tend to hold or gain value amid geopolitical instability. It's a way to protect against tech stock declines while potentially capturing gains in sectors tied to inflation and energy demand.
And finally, Linda from San Francisco asks, how can I protect my portfolio against sudden market downturns if the situation escalates? Linda, a proactive approach can make a big difference here. Setting up automated stop-loss orders on tech assets, especially those tied to semiconductors, allows for fast reactions if the market takes a turn. Some investors are also looking at option strategies, like call options on inverse ETFs, which act as a buffer if there's a sudden drop in tech stocks. These tools provide some peace of mind, knowing you have a system in place for quick moves when needed.
Great questions, everyone. It's always smart to be proactive in times like these. Keep sending us your questions from across the country. We'll keep providing insights to help you navigate this complex landscape. If you'd like more in-depth answers, connect with us on social media, and remember to tune into future episodes for additional strategies. As we wrap up today's episode, it's clear that the stakes are high, and geopolitical risks like the China-Taiwan situation require careful attention. We've covered strategies to navigate this uncertainty, from hedging with commodities and safe haven assets to diversifying tech exposure.
Remember, it's all about balancing caution with opportunity. Whether you're rebalancing to reduce specific risks or positioning yourself in sectors like energy or defense, the key is to stay informed and adaptable. These moves could protect and even strengthen your portfolio in the weeks ahead.
Thanks for tuning in to Finance Frontier. Keep sending us your questions, and don't forget to connect with us on social media for real-time updates and more insights. Stay proactive and join us next time for more financial strategies that meet today's evolving landscape. This episode of Finance Frontier is intended solely for informational purposes and does not constitute financial, investment, or legal advice. All investments carry risk, and past performance is not indicative of future results. The views and opinions expressed are those of the hosts and may not reflect the views of Finance Frontier, its affiliates, or sponsors.
We strive for accuracy and use information from trusted sources, but Finance Frontier makes no guarantees as to the completeness, accuracy, or suitability of the information presented. We encourage listeners to consult a qualified financial advisor to make decisions best suited to their individual circumstances.
The news and analysis provided in this episode are based on current market trends. Remember to always consider these insights within the context of your own financial strategy.
Special thanks to Twin Musicom for the music used in this episode. Not Without the Rest. Licensed under Creative Commons Attribution 4.0. You can find it in the YouTube audio library.
Copyright 2024 Finance Frontier. All rights reserved. Unauthorized use or distribution is prohibited.